How can I donate appreciated property for tax deductions? Imagine turning your investments or property into a way to support causes you care about while saving money on taxes. That's what donating appreciated property can do for you. When you own assets like stocks, real estate, or bonds that have increased in value over time, donating them directly to a charity can be a smart move. It helps you avoid paying capital gains tax on the appreciation, which is a big advantage. First, you need to know what appreciated property means. It's an asset you've held for more than 1 year that's worth more now than when you bought it. If you bought stocks or property years ago and they've gone up in value, they qualify. The key is that the property has a higher fair market value than your original purchase price. Next, hold onto the property for more than 1 year. This is important because if you sell it within a year, your deduction is limited to what you paid for it, not its current value. When you donate long-term appreciated property, you can deduct the full fair market value on the date of the donation. You must donate to a qualified charity recognized by the Internal Revenue Service. The donation should be a gift, meaning you don't get anything in return. For property valued over $5,000, the IRS requires a qualified independent appraisal to prove the value. This appraisal must be attached to your tax return to support your deduction. There are limits on how much you can deduct based on your adjusted gross income. For long-term appreciated property, the deduction is usually capped at 30% of your adjusted gross income each year. If your deduction exceeds this limit, you can carry forward the remaining amount for up to 5 years. When you report your donation, you need to itemize your deductions on your tax return. For non-cash donations over $500, you must fill out Form 8283. Larger donations requiring additional documentation. Donating appreciated property is a way to avoid paying capital gains tax, which makes it more tax efficient than selling the asset and donating cash. If you have property that has been depreciated, like rental real estate, the fair market value for deduction purposes is reduced by the accumulated depreciation. You have options for donating appreciated property. You can give it outright to the charity, claim a deduction for its fair market value. Or you can sell it to the charity at a bargain price, which allows you to deduct the difference. Another option is setting up a charitable remainder trust or retained income arrangement, which lets you donate while still receiving income for a period. For Asian American taxpayers, this can be a strategic way to reduce taxable income while supporting community organizations or causes important to them. Just remember to document everything carefully, get proper appraisals, and consult a tax professional familiar with charitable contribution rules. In summary, donating appreciated property held for more than 1 year to a qualified charity allows you to deduct the full fair market value up to 30% of your adjusted gross income, avoid capital gains tax, and carry forward unused deductions for up to 5 years. Proper documentation and following IRS rules are essential to maximize your benefits.